Welcome to Lecture 18, and this lecture will cover taxation on capital. The prescribed reading is, as before, Stiglitz and Rosengard, but we are looking at Chapter 21 now. In this chapter, we continue the discussion of taxes, and this follows from a discussion of what the optimal system of taxation could be or should be in the previous lecture. What we will discuss in this chapter is as to whether capital should be taxed, the effect of taxes on both savings and investment, and also the impact of taxation on risk-taking. So those are the three main topics that we shall cover in this chapter. So before we proceed about discussing the taxation of capital, we need to know what is capital. Well, capital you can view as some kind of money that has been invested, let's say into bonds, and or just simply savings which earn interest, much like bonds which earn a higher level of interest, or alternatively money invested in securities such as stocks, which generates some kind of return, or alternatively money that has been invested to purchase an asset and then that asset is sold at a higher price. The difference is a capital gain. So what we are essentially taxing are returns to money that has been invested into either some kind of financial security or some asset. We are taxing those returns. So the discussion is about taxation of returns on capital. Now, what are the arguments for taxation on the returns to capital and against the taxation of returns on capital? Well, one argument is that capitalists are wealthier than working people, and therefore capital should be taxed more heavily based on the capacity to pay. This arises from the idea that those that have money to invest are wealthier, and hence they have the ability to pay these taxes and hence should be taxed. Alternatively, recall what happens, or think about what happens when you save money. Well, that money is channeled into projects that are undertaken by firms or for firm expansions. In other words, the banks uses these to make loans to firms and businesses in order to expand their operations. Now, the idea is if you don't save money or if you don't invest in assets, financial assets, that source of funding is no longer there for others to use to extend the enterprise, to build their enterprises. So hence there is a disincentive by taxing capital on saving and investment. The issue that we are concerned with here in this lecture is what is the appropriate basis for levying taxes? And the problem that we also come up against is that corporations make the taxation of income from capital very complicated. So what we attempt to do in this lecture is to ignore these complications by focusing on a simple economy in which individuals own their own firm, investing their savings in capital, facing decisions on how much to save and to invest and what to invest in. So again, we use this concept of abstraction that is quite common in economics. Otherwise, the world would be too complicated to analyze within the realm of economic theory. So should capital be taxed? That is where our point of departure begins. The debate on whether capital should be taxed has centered around three issues. These are equity, efficiency, and administrative complexity. And what we will do is we'll start with the equity issues. So one of the most forceful arguments for basing taxes on consumption as opposed to income was argued by or proposed by Irving Fisher, who was an American economist that lived between 1867 and 1947. And his argument was that it's more appropriate to tax individuals on the basis of what they take out of society. In other words, their levels of consumption, as opposed to what they contribute to society. That is their income. As we proposed in Chapter 18, taxing consumption is the equivalent of taxing lifetime income. Thus, with a consumption tax, two individuals with the same lifetime income will have the same total tax burden. Now, on the other hand, if we tax income, the problem with this is that it discriminates against those who prefer to consume later in life. And this argument supports excluding capital income from taxation, or equivalently taxing consumption. Why? Because what I can choose to do now is to not consume with my money in first period, and instead save that money and be able to consume more at a later point in time because I would have earned on my capital investment. Okay, in other words, my capital would have yielded income. But because of a tax on capital income, I would be disadvantaged for saving today. In other words, I would get a smaller return in the presence of a tax because all that interest that I will earn, let's say I invest in an interest-bearing account, would be taxed in the second period. Then we have efficiency arguments. So first of all, one argument towards or in favor of consumption taxes is that consumption taxes lower dead weight loss. Related to this is that idea that consumption different dates should be treated like the consumption of different commodities. Think about good A and good B. Those are the two goods. You can either consume more of good A or consume less of good B, or consume more of good B and less of good A. Now think about present and future consumption. You can choose to consume either more in the present and less in the future, or you can save now and then you can consume more in the future. So the present and the future are an analogy to consuming more of good A and less of good B, or vice versa. Instead, what happens is, though, what you do is you save money and then you can consume more in the future, but less in the present. So the present is the equivalent of good A, let's say, and the future is the equivalent of good B in such an analogy. In this instance, the argument is that the most efficient way of obtaining redistributive goals through a progressive wage income tax implies that there should be no differential taxation on consumption at different dates, which in turn implies that capital income should not be taxed. Think about the distortion that arises in layman's terms. Well, if you save money, but you'll be able to consume less, in other words, you'll be more able to consume less in the future if there had not been a tax, you can potentially will consume more in the present because you know that you will not get your full return in the presence of a capital tax. Then what we have is the issue of administrative complexities. And here what we face is concern with administrative complexities of tax laws, which provides a rationale for moving towards a consumption base. The idea is that we don't need to strictly monitor consumption. Instead, what we need to do is we need to measure incomes and savings. Why? Because the level of consumption is the difference between incomes and savings. So hence, what we can do is we can infer the level of consumption. But of course, the problems of implementing either a consumption tax or an income tax might not really differ. It is still not easy to tax either income or consumption. Now we turn to the core issue of the discussion of taxing returns on capital. So what are the effects on investment and savings specifically? Well, taxation of returns on capital up to a certain point, I must add, is fine. However, beyond a certain point, what will happen is that there will be a reduction in the level of savings. And this translates into a reduction in capital stock. Why? Because savings are channeled into physical capital. So for example, you leave your money with a bank, and that money is used to make loans to firms to purchase assets to produce more goods. Well, if taxes are so high on returns to financial capital, the result is such that there is a disincentive on saving. You'd rather spend everything now and not invest. And as a result of that, if there's a reduction in savings, there is a fall in capital stock. And as a result of that, we have a reduction in living standards. So this can have a consequence. Let's analyze this problem in terms of this issue in terms of the demand and supply framework. So first of all, what we have is we have a supply of savings. and the supply of savings curve slopes upwards. Why? Think about it this way. The more you get from saving your money, more of a return, that is a higher interest, what are you going to do? You are going to save more. Let's say you can get 50% a year by saving. Well, you're going to save a lot more than if you can only get 10%. So that is why you as a saver will provide savings, or will save more, because of the higher return. But there is also another party to this equation, and that is those that demand investment. In other words, those that want to invest money. And where do they get the money to invest? Well, by going to a bank, and the bank channeling your funds to those that want to invest. Now, of course, what they have to do is, those that want to invest money and hence need funds, what they need to do is they need to pay some kind of interest on it. If interest is high, the price of obtaining these investment funds is high. So this is where we will hypothetically be on the demand curve. On the other hand, if the price in the form of interest that must be paid by those that demand funds for investment, then what we'll have is we'll have a higher quantity of investment, in other words, borrowing or drawing upon the savings of others through a financial intermediary such as a bank. Equilibrium occurs at the intersection of the demand and supply curves, and the corresponding level of interest in equilibrium is R subscript 1. That's how we define it. And the equilibrium level of investment and savings, the point at which the quantity of savings is equal to the quantity of investment, is I subscript 1. Now let's say that we impose a tax on savings, specifically on the return to investment and to savings. So what is it that happens? Well, you as the provider of capital in the form of savings receives a lower return. So this is the level of returns that we now receive because of the tax. On the other hand, the person that is the borrower, in other words, that person or that firm that is seeking investment, has to pay a higher price because of this tax. So ultimately, what we see are lower levels of investment. Specifically, equilibrium level of investment is reduced to this point here. So with lower levels of investment, what we see is a drop in capital stock in the economy, right up until the point that standards of living are impacted. Okay, recall, you go to a bank, you have savings, you deposit money. Those savings are used to make loans to firms. Those firms use those loans in order to build new factories and produce more goods and hire more people. Well, if you save less is invested. Firms build less factories, employ fewer people, and produce less. So what do you have? A fall in the standards of living as a result. Let's introduce a tax credit into the economy. Let's assume we have a closed economy, and this implies that the amount of savings is equal to the amount of investments exactly in equilibrium. Now, let's say we want a policy that will promote investment. What we can do is we can institute a tax credit. What tax credit means that part of the costs associated with investments are covered by the government or are tax deductible. So for example, if a firm chooses to invest, it needs to get funds. So it needs to borrow funds. So it borrows those funds, and the source of those funds is savings. Now, the cost of those savings, or borrowing those savings, is the interest. By giving an investment credit, what happens is that the cost decreases. The result is we see an increase in the demand for investment in such a situation. This is associated with a higher equilibrium level of investment, but also a higher interest rate as the investment demand curve shifts to the right. Let's look at another situation. So let's say the government now wants to begin taxing savings. The result of that is a leftward shift of the supply curve. So hence what has now happened is we've gone from this point to that point initially. So the equilibrium level of savings and investment has dropped, and interest has risen as a result of a tax on interest income. So there's a disincentive to save. And that is why we have a leftward shift in the supply curve of savings. What government can do is it can now introduce a tax credit to offset that tax. The result is we go back to having the same level of investment. So this is now our new equilibrium level that corresponds to the quantity of savings after taxes and also the quantity of investment after a tax credit. The result is that yes, the interest rate is higher. However, we are back to the same level of equilibrium investment. So we see two situations. Here, what we see in panel A, in summary that is, we see the impact of a tax credit. In panel B, we see the impact of an interest income tax. And then we also show how we could offset this by using tax credits in order to ensure that the level of investment remains the same. We also need to consider the macro aspects of taxing savings. So what we look at is the level of national savings and budget neutrality. What is it that matters for a nation's investment? It is not just the level of household or firm savings, but also national savings, which includes government savings. If you reduce a tax on returns to capital, what will happen is that government revenues will drop. If you are paying taxes on capital gains, well, that is going to government revenues. So that increases government revenues. And hence, if you reduce taxes, government has lower revenues. The result of this is an increase in the deficit unless taxes are raised elsewhere. So, for example, if government wants to ensure budget neutrality, what it needs to do is it needs to, for example, following a decrease in taxes on capital, it needs to raise taxes on, let's say, wages to offset the decrease in revenues from the decrease in the tax on capital. So the result is that revenues might be unchanged and hence government savings are unchanged. So savings, in fact, might be increased if a tax imposed in such a manner that while capital taxes are reduced and hence or taxes on capital returns are reduced and hence encourage savings, but at the same time there's another tax that increases government revenues, meaning that private and firm savings might increase and government savings will stay the same, and hence total savings will be greater. That is following the reduction of capital tax and an increase in a different tax to offset the drop in government revenues. Let's analyze the impact of a compensated change in taxes. So what we do is we cut the tax on capital or interest or income from capital, but we increase the tax on wages. What is the effect of this? So this is an application and reference theory to describe how government or show how government could promote savings. So let's assume there is currently a tax that is being charged on returns from capital. And what an individual can do is they can earn now and consume all of their income now. And what they can do is they can save all of the income and then consume it in the future. In other words, what we have is we have two periods of consumption. Let's say your working life and then your retirement. And we denote current, the present period, as C subscript 1 and retirement as C subscript 2. And the situation that we are facing is that government wants to cut taxes on income from capital to promote savings, but does not want to run a budget deficit. So what it needs to do, it needs to cut one tax and raise another tax. So how we could represent a budget constraint in the absence of an income tax is as follows. How we could represent a budget constraint and the point that we are consuming at in the presence of a tax on capital is as this budget constraint. Currently, we assume that the individual is consuming at this point here, at point E, and the level of consumption corresponds to this point on the horizontal axis, and this point on the vertical axis represents consumption in the second period. So now what we do is we cut or eliminate the tax on interest, but we impose a tax on income. The result is that we are now on another budget constraint. This is the budget constraint that we are now on. So we move away from being on this budget constraint with interest income tax curve, budget constraint curve, to one where we are paying a wage tax, but we are no longer paying tax on interest. In other words, capital gains are not being taxed. What is the result of that? We moved from this point in equilibrium to this point. The result is such that we save more and hence consume more in the future, but we consume less in the present. So hence, what has happened is that the government has encouraged savings. Moreover, what has happened is that there's been an increase in government revenues. So revenues are now represented by the distance between point FE, and point F, and then point E and point F apostrophe. So the deficit is reduced. So what is the outcome of this intervention? Assuming a concave indifference curve, the outcome of the intervention is that savings are now encouraged. Now, why does this matter and how does this relate to practice? Well, recall there is always the problem that people that retire do not have enough income to live on. Well, as you can see, what we have shown here is that by increasing a wage tax in order to retain a balanced budget, and decreasing tax on capital gains increases savings, and these savings will be retirement funds then. However, if we have an L-shaped indifference curve, well, the result is that private savings and government revenues are both unaffected. So hence, reducing a tax on income from capital and raising a wage tax has no impact on savings in this instance. So therefore, it depends what the indifference curves are like as to whether such a policy would work. That of cutting taxes on capital gains would work to promote savings or not. Recall that what we assumed on the previous slide is that we were dealing with a closed economy, on the previous set of slides, that is. In other words, an economy that doesn't really trade with the world. And what this meant was that in equilibrium, savings were equal to investment. Now, what happens if we are dealing with an open economy? Well, the result is that the effects of capital taxation investment may be greatly reduced in an open economy where foreign savings can serve as a substitute for domestic savings. Why is this the case? Because what people can do is they can move their funds offshore. And what has happened during the last 5 decades is that there has been a robust international capital market that has developed. In other words, it has become more accessible for us to invest outside of the country that we are domiciled in. So what has been happening is that the US, as the CSUS textbook, has been borrowing hundreds of billions of dollars from abroad. How is this happening? Well, foreigners are investing in the United States, either by buying bonds issued by the United States Treasury, or alternatively by investing by buying shares on US stock markets. And there's a number of stock markets in the US. And as the United States is an attractive investment destination, or at least was given the turmoil in the United States, there is a belief that a small change in the interest rate will have a large impact on investment to the United States. Put it this way, let's say that the United States decides to raise its interest rates. What does that mean? That the interest on securities offered in the United States, such as treasury bonds, treasury bills, is higher, hence the return is high. So funds flow rapidly into the United States. So that is why many economists believe that the supply curve for funds to the United States is close to horizontal. In other words, this curve is a highly elastic curve. The quantity of funds supplied, or the supply of funds to the US, is highly responsive to changes in the interest rate. So Let us see what the situation would look like if we have both savings from abroad and also savings domestically. So because we have a high elastic supply curve for foreigners, what we do is we represent it as curve FF. The rate that prevails is that rate. Then what we have is in the domestic market, what we have is we have an upward sloping savings curve. So then the amount of savings or funds that can be invested is represented by S subscript 1. That's for the domestic savers. And then the rest is made up by foreign savers. So the equilibrium quantity of domestic investment is then I subscript 1. This is where we'll end up being. In other words, the difference between domestic savings and investment is made up by foreign savings, which are then channeled into investment. Now, let's say we impose a tax on citizens in the United States. What is that would happen? Well, the result is that the savings curve would shift to the left. So, less would be saved by domestic savers. So what is it that would happen? Would this impact investment? Well, no, it wouldn't impact investment. And the reason why is because the difference, which is now larger between domestic savings and foreign savings, grows in order to fund the level of investment that is demanded by investors. Because savings decline, there is no impact on investment because they are made up for by foreign investment. However, there is an adverse effect on the standards of living in the United States. And the reason why is because more funds are now coming from abroad in order to fund investment as opposed to domestically. So US citizens will owe more money to foreigners, and more of what is produced in the United States will have to be sent abroad to pay for this debt. What about the impact of taxation capital in terms of risk? Now, why does risk-taking matter? Well, in order to discover something new, or in order to be an entrepreneur and set up a firm, there is a level of risk that is involved. Now, there is a bit of a concern that if we start imposing taxes on capital, what will happen is we will discourage not only the overall level of savings, but also the level of risk-taking by people. So most people tend to be risk averse. They don't really like taking risks, but there are some that are willing to take risks nevertheless. But they have to be compensated for taking on that risk. And the larger the compensation, the greater the probability they will take that risk, of course, or more likely they are to take that risk. So they would expect a high return for risky investment as opposed to a safe investment. Now, if we impose a tax, what happens? The return to an investment or savings, whichever way you want to look at it, declines. So you can see that this is the way that this is going. This has the potential to discourage risk-taking. Let's elaborate a little bit why risk-taking is so important. Well, in order to invent anything, what we need to do is we need to take risk. We need to invest. And the nature of investment is that there's no guaranteed return. But what is it that these investments lead to? Well, they lead to the cars, motor vehicles, the airplane, computers, and all of this requires funding. So this is the result of all these inventions are the results of investors and firms deciding to gamble their wealth on a new idea. So risk-taking, in other words. Although all of these inventions are successes, we must not forget there are dozens, if not hundreds, if not thousands of failures behind every successful invention. I believe that Thomas Edison tried about over 200 light bulbs before he got one right. So government intervenes in this market by taxing the fruits of that success. So it takes some fruits of that success away. And that's where our taxes go. So we invent something, we start selling it, we get taxed on our income. There is also another side of the equation. Sometimes government does not do much to help bear the costs of failure. So government tends to benefit from success, but bears none of the costs that are associated with failure. Furthermore, usually when there is a failure, entrepreneurs are severely impacted, and it is difficult to divest themselves of the risks associated with entrepreneurial activity. So the return is already small, even if we don't have taxes. Let's demonstrate the impact of taxes on risk taking. Let's assume that we have two assets. We have a safe asset, which yields no return, but you don't lose your money, or you have a very risky asset that has a 50% of making a large return or 50% of making a negative return, so no return. The average return on the risky asset is positive, and the reason why it's positive, so if you add the negative return that you can earn or lose, that is, and the positive return that you can get and divide by 2 as it's 50-50, well, the result is that overall the average of this return is positive. And the reason why is it's to compensate the individual for taking risk. If we are dealing with a conservative individual, what that individual do is they allocate a fraction of their funds to a safe asset and the remainder to the risky asset. Now we impose a tax on capital, and what we do is we allow a full deduction against other income for losses. So let's say we make money elsewhere, let's say we earn a wage. Well, what happens is we can deduct whatever we lose. The result is that the safe asset is unaffected, but the risky asset has its return cut by half. Of course, if the return is cut by half, so are the losses. Now, what is the response of an individual to this? What an individual will do is they will double the previously invested amount in the risky asset. Why? Because they were seeking a specific return, but that return was cut by the imposition of a tax. So what they need to do is they need to invest more in order to receive the same return in money, in monetary terms. So ultimately what has happened is the individual is completely unaffected at this point in time. So what is happening is that the government is sharing in the risks, by its willingness to share in the risks, the government is acting as a silent partner. Individual is willing to increase her or his risk taking. But remember, this assumes that we can write off losses elsewhere. So again, let's say that I lose from my investment and I'm also earning a salary. So hence my taxable salary declines. And that is how the government is sharing in the risks, by allowing you to offset your losses against earnings that you may have from other sources. This is a very important point and necessary for this to work. So hence, such a policy does make sense of taxing a return on capital, provided that losses can be offset against other sources of income. What happens is, in this instance, the tax does what no other tax seems to be capable of doing. It seems to raise revenue without lowering welfare. However, we must be aware of some of the caveats in mind. So there are limitations on the magnitudes of losses that can be offset. So that is again key. Thus, the government, while sharing in the gains, shares in only some of the losses. So this is a bias that nevertheless exists against risk taking. So for example, you are able to offset £20,000 of your losses against your current earnings from other sources. Anything over that, let's say you lose £30,000, well, then you've lost £10,000. By offsetting these losses, what this means is reducing your taxable salary, so you pay less in terms of tax in case you incur a loss on a risky investment. In other words, you're not as impacted by this loss as if there was no offset at all. So in conclusion, tax seems to be beneficial in this instance. It seems to raise revenues while sharing some of the risks associated with an investment. But nevertheless, there are limitations to that because of how much losses can be offset. And thank you. That concludes our lecture for today.